morning's jobless claims came in slightly above estimates. The report comes as Wall Street awaits tomorrow's September jobs report and its impact on the next Fed move. So joining us now is Claudia Sahm, chief economist at New Century Advisors and a former Fed economist. Claudia, it's great to have you on. Obviously, there's a lot of focus on labor data right now, especially as we started to see the labor market soften. We know inflation is sort of under control and trending in the right direction, and everybody's wondering whether we get 25 or 50 basis points at the next meeting. So what are you expecting based on your modeling for tomorrow, and how much actually hinges on this report?
Well, with tomorrow, the best case, what we're looking for are some signs of that cooling in the labor market, which has been happening for many months. We just want to see things stabilize because we're in a relatively good place. So it's more of just that stabilizing. Nothing is going to be decisive tomorrow, not for the state of the labor market over the coming months and not for what the Federal Reserve is going to do. And yet it's extremely important that we avoid those, scary signs of, a jump in unemployment, really low payrolls. That's not my base case for tomorrow, but that's what we need to keep an eye on.
It does seem to me, though, that the Fed's job of assessing this data may get trickier here over the coming weeks because we get one more jobs report after tomorrow before the next FOMC meeting. And we had this devastating Hurricane Helene. We've got Boeing workers on strike. We now have a big port strike finishing its third day. And I wonder how noisy that could make some of the data we get between now and then.
Right. Any data print we get can be tricky to read. Things like the port, if the strike would go on, that can be relatively easy to see in the data. We can isolate that. There are certainly other ways with hurricane effects, which is what we've been dealing with in the last couple months, trying to parse those in and out of the labor market data. So that's certainly the case. This month is kind of a clean month in terms of we don't have an event that we're trying to pull out of it. And also the data we're getting come to us were measured before the Fed began their easing cycle. I mean, it had been telegraphed, but we hadn't seen those 50 basis points. So you throw that into the mix, too. The Fed is going to be very interested to get any kind of sign on going forward how their interest rates are affecting the labor market. So, yes, it's going to be messy.
Claudia, it seems like your take is that if we end up getting a 50 basis point cut, it's because something's gone very wrong. I also wonder if you expect we're going to continue to get these rather large revisions to previous jobs numbers.
All right. So Fed Chair Jay Powell this week was pretty clear, and I think very consistent with what he said at the last FOMC meeting, that, the baseline, if things go as expected, and most Fed officials are expecting the unemployment rate to continue to drift up some from 4.2, where it is right now. So they wouldn't be surprised if things weaken a little more. It takes time for the interest rate to come into play. So if things go as expected, we'll see 25 basis point cuts, maybe consecutive ones through the end of the year. So a kind of a much more standard issue Fed approach to the labor market cooling as opposed to the bigger 50 basis points. So it's going to take some bad news on employment and not just one data point. Right. I think they'll want to look at both of the employment reports, and it takes some really good news on inflation, I think, to move them off of this 25 basis point consecutive. Let's move, with purpose, but not, with great speed towards, their lower interest rate. And I think that's completely appropriate, but it so depends on the data. This is a data dependent Fed, a massively data dependent Fed, and that is not changing anytime soon.
So is 148,000 cool enough? Is it close? Where's the line for too cool on the labor number?
Right. Well, when we're in the world of revisions, we have to be careful about getting too attached to one particular number, because what we see tomorrow might look different in a month. But there are things that start moving below 100,000, getting towards, even a zero or a negative print. That would cause some concern. But we should remember the U.S. economy is very complex. It's dynamic. It's hard to measure. Cue up those revisions. And so things are imprecise. Even if we were to get a negative payroll print, that does not necessarily mean that the bottom is falling out. It just means that we're, in the low 100,000s, and that, there's noise. So I think that's going to be the tricky place right now, is where the economy, the labor market still looks pretty good, but it may send up some red flags that, cause concern. And we just have to look at the big picture and all of the data, not just the labor market. And we've gotten a lot of other good data recently that bolsters the case that we're pointed in a good direction. It's just there's, some things to look out for in the labor market.